Okay, I'm going to go ahead and get started, which usually means several more people will join. Um, I'm Jenn Ryan. I'm the SVP of Global Network Operations at Xometry, and that includes partner. We're committed to bringing our partners timely and relevant information. So some of you may have been with us last week, and we're very excited and proud to present today's content. I'm going to do a couple housekeeping items. One is that we will be recording the session and sending out the link. Another thing to know is that we understand that there's going to be noises and interruptions and video problems. So we're all gonna try to be on mute when we're not speaking, but this is a friendly space and we get it. Another housekeeping item is to remember that today's session is intended to be helpful and informative, but it's not to be taken as specific financial guidance for your organization. If you have a question during the presentation, go ahead and use the chat feature, and we'll get to it at the end of the panel. If you've pre-registered a question, then we have those queued up with our experts, and we'll move to those directly following the presentation. One last thing, if you have ideas about future webinars, speakers you'd like to see, let us know, and you can you can go ahead and put those in the chat window. One of the things that we know, and we said this last week, is that if we're not bringing you information that's relevant to your business, you're not going to trust us with your business. So we want to keep that conversation going. As I move into introducing our experts, one of the things that's important about this is that we want you to know that small manufacturing is the heartbeat of Xometry. I shared with you guys last week that I grew up in the trades, so this is personal for me. And we know that small business, not only has it been fueling many of the breakthroughs in COVID response, but it's going to be a big part of the recovery. Today, I'm introducing esteemed panelists from Armanino. It's one of the top 25 largest independent accounting and business consulting firms. Armanino provides an integrated set of audit, tax, consulting, business management, and technology solutions in the US and globally. They've been named to IPA's Best of the Best Firms and Accounting Today's Pace Setters in Growth. We're fortunate to have these experts here, and they will talk to us about how we can apply some of these kind of coterie of programs to our small businesses. Before I turn over the mic, I want to say thank you again. Small businesses, one of their most precious things are time, and you guys have given your time to this. We are nothing without our partners, and the people on this phone are dedicated to continue to bringing you important content. Our first speaker is Jenn McCabe. She has more than 25 years of outsourced accounting and finance experience, and she has particular expertise in startups. She's a partner with the firm. Jenn?
Thank you. Gerry Clancy is with me. I want to make sure that I give him a shout out after I take you through my small business spiel here. I'm a small business fanatic, just so you know. That's really all I care about. I'm known for it at the firm. I get a little bored on bigger clients. So Gerry is here. He's a tax aficionado, and he will pick up where I left off and fill in the gaps. And he may interrupt me if he finds that I'm missing something. So know that that's how we work together. Let's go to the next slide. Are we going? Help. I don't know how to make that go. Okay, there we go. All right, so the first thing we want to talk about is what makes the phone ring off the hook at our firm these days, that SBA has put out a bunch of news. They are supporting the CARES Act in a variety of ways, and the SBA has been put on the front line and told by the Treasury that they have to have these 3 kinds of loan products. They were told that even though they weren't ready to do this. As we all know, they were not ready. So the first one that came out that you've all heard about too much is the PPP. I anticipate that the money for the PPP will be gone before the end of the week. They had news out that by the end of day Friday, they had given away half of the new tranche. So We're moving beyond the PPP now, and we're going back to what's called an EIDL loan. This loan is an economic injury and disaster loan. They're usually loans that they give out after tornadoes. And, you see them in the South. After Hurricane Katrina, the EIDL was very popular. It helps businesses recover from a disaster. So this is not loan money like a bank would normally give you that you can use for any purpose. All of these monies come to you with certain designated usage. So the EIDL has some trips there. You're not allowed to use it to finance. It's only up to $2 million. They really want you to use it to help your business recover, not build it. So the other day I was on the phone with someone who wanted to use their EIDL money to buy another piece of business. And I said, no, that's not what it's for. That's going to make some people really edgy with you. So the next thing that's coming out now is the Main Street loan, and this is not ready to go by any stretch, but everybody's talking about it, and they have expanded it. So it used to be that the minimum loan was $1 million. It's now $500,000. It used to be that you had to have up to 10,000 employees, and now they're saying no, it's up to 15,000 employees. So they're trying to make this product more accessible. And we'll wait and see what happens. But if you're listening and the PPP wasn't enough, or you haven't gotten satisfaction from the EIDL, or the $2 million on the EIDL isn't going to be enough for you, think about the Main Street. But here's the big but for me. You have to keep your staff. You have to show that you're keeping your staff. So as everything in the CARES Act, this is about payroll. This is about employees, keeping people with jobs. So when in doubt about what to answer a client, I always revert to the intent of the law, which is to keep jobs. Now, the Main Street loan, not only is it supposed to keep people employed, but there's a lid on the stakeholders, shareholders, and executive salaries in the Main Street loan. And that cap stays on for the 4 years that you have this loan. And the rigorous standards to which they hold you to hold those jobs open and that headcount open, they hang in there for 4 years and then go beyond that. It's a year or two after you pay the loan off. So it's an interestingly structured loan that really keeps you in a certain discipline. We'll go to the PPP again because, that's where everybody still is. Their heads are still in the PPP, and for the next 2 months, probably the PPP will be what we all obsess on. Next slide, please. I don't have control, I promise. Okay, so the PPP loan was the first one that came out, and the reason that people were so excited about it is that there's this element of forgiveness, they're calling it, which really means that this is not a loan. It turns into a grant, and it turns into a non-taxable grant, and that makes everybody very excited about it. So the problem that we have is that there's been ambiguous discussion from the CARES Act and the Treasury and the SBA about what is going to be forgiven. So everybody knows by now it's for payroll, because of course it's payroll protection, rent on your office space, and utilities. That's really the basics. There are some rules, like you can use the money to pay your mortgage. Say that you own the building you're in and you pay the mortgage. You can use your PPP money. Use is allowable. You can pay your mortgage, but only the interest is forgivable. So if you pay a mortgage, you have to know it's allowable, but not 100% forgivable. So there's tweaky stuff throughout. The most important tweak that I will say to everybody is there are two ways they're putting forgiveness, broadly speaking. They are saying 75% of the proceeds, the loan, the total amount that you get must be used for payroll, at least. But they are also saying no more than 25% will be forgiven for utilities and stuff that's not payroll. So they are saying two different things. My example is if you have $1 million, you have to spend $750,000 on payroll. But what if you spend $600,000 on payroll and $200,000 on utilities and rent and stuff? Only 25% of what you spent it on was used on utilities. That's one of their rules. So we're navigating both, and we're doing the math both ways. Suffice it to say that everybody should be intently focused on only using the money for the purpose it was intended. Don't be going to buy a new car. Don't refinance your house. Stick to the rules and you'll be fine. The amount that's forgiven is going to be reduced if you have done something to your payroll, if you have reduced headcount. And it's actually FTE. We've confirmed that. It's not headcount, it's FTE. We don't know if that's 30 hours a week for an FTE or 40, but it doesn't really matter. It's FTE. So if you reduce your positions at your place and reduce the hours that people are working, some of your forgiveness will be reduced pro rata. And then there's a dollar.
So Jenn,
Yeah.
on the FTE, can you explain what the distinction was there between that and positions?
Yeah. So on the applications for the PPP, the banks asked everybody for number of headcount or positions. So say that you're a retail store and Gerry and I both work 20 hours a week. That's 2 jobs, 2 positions, but it's 1 FTE. So what we did on our applications for our hundreds and hundreds of clients was we did it both ways. We did FTE and headcount, and that's proving to be very strategically helpful as we approach the forgiveness side of this. You need to go at it and figure out the FTE. The other reduction in addition to the FTE reduction is there's a dollar, the FTE reduction is a percent. So if you reduce your headcount by 10%, your forgiveness is reduced 10%. If you take my salary down by more than 25% and you pay me, say, 50%, the dollars you pay me are also subtracted. It's not a percent, it's a dollar subtraction. We think that's the way we're reading it. So if I was a $100,000 person and you reduced me to 50,000 and you paid me 50,000, my $50,000 would be allowable, but it would not be forgivable. You would have to pay me $75,000 for that to be forgivable. So they're trying not just to keep headcount, they're trying to make sure that you don't just reduce everybody's salary down into the basement, okay? Obviously, that means you have time to rehire people. So we're doing a lot of math on when it's the right time to hire people back, because you need to get your headcount or your FTEs back up to satisfy equation part 1 before the end of June. And I am telling people it's safer to assume the end of your 8-week period. If your 8-week already started ticking, you should probably be ready for them to say you have to increase headcount during that period. They haven't confirmed that. They've said June 30th. But it makes me a little nervous because they have been a little ambiguous. Whatever's left over that you use and isn't forgiven is a 2-year loan at 1%, which sounds pretty good to me. And I want people to use the money wisely rather than rush to rehire, rush to spend the money. You might need the capital more in August so that you're still alive in August. So we've been counseling people that way. Obviously, there's a strategy here. All right, next slide. Got to keep myself moving forward.
Yeah, and I just wanted to tell you there is a slight delay just because of the system. So we're clicking it, but we'll have a time for a deep breath after each one.
Okay, good.
It'll be a little pause.
Okay, so last week the Treasury and the SBA finally released guidance on what need is, kind of. All right, so they at least said, a month ago, everybody said, geez, I'd be a dum-dum if I didn't apply for the PPP. There's no rules. It says I have to need it. Well, what's need? And we were counseling people. Well, come on, your moral compass tells you what need is, doesn't it? And that wasn't good enough. Some people applied who really shouldn't have. So it became clear that people were applying for the money and that it was going to only big people and not little people. And it was really intended. It was all gone by the time sole proprietors started applying, which was really sort of sickening. So they said, well, okay, wait, you need to really need the money. And that changes. The definition of need changes for every company. So I've been saying, hey, go back to the attestation, the representations you made when you signed that loan. You need to show that you had economic uncertainty. And that could be that your CFO showed you a bunch of projections and they were really, maybe some were okay and some were really scary. That is uncertainty. If you drew down your line of credit because you were uncertain, that would indicate uncertainty. If you have a source of funding that has come through for you over and over again, and in your heart of hearts, you would have been okay, that's different. If you, I say to CFOs a lot of times, what would you have done were it not for the PPP? how would you have survived? And if the answer is we wouldn't have, that's an easy answer. If they say, well, I would have done this or that, I would have been okay, that's another answer. And then the last thing, of course, is you must stay true to the intent. You must use the money to keep workers employed. That is what it's all about. So when people call me and they say, oh, I'm nervous, I say, go back to your board, make sure everybody's comfortable, because the PR on this is going to be ugly next year. And you don't want to be in that. And if you're going to go public, or you're going to borrow money, or you don't want it appearing on your audit statement and you're embarrassed, then take it out and send it back. You have until May 14th. By the way, it changed. It's now May 14th. You can return the money. No harm, no foul. It's called a safe harbor period. They're not going to ask questions, apparently. The news this morning was that the Phoebes were after some people already, though. So I think that people need to be very clear about their intent to keep the money and what they'll use it for, and that they'll be able to show that it really helped them continue their business and continue to hire and employ people. Okay. All right. Next slide.
So along those lines, I had a call from a client this morning. They got 4.8 million for the PPP. And they did it they applied based upon about 12 different risks that they had identified to their business. However, after several weeks of operating, many, if not all, of those risks have subsided to a point where they reached the conclusion that their business hadn't actually been economically impacted too negatively. Their revenue stream was still similar to what it was. So today they wrote that check back to the SBA, or back to the bank, for $4.6 million. So that just gives you an idea of what the considerations are. And I think they took it in good faith initially, but upon further reflection, they realized they weren't what this was meant for.
Nice. Well, that's good news, actually, that people are finding a way through this too. And then that money can go help. The average loan is $200,000. So that loan could help 96 little companies. And I would feel pretty good about that. So what Armanino has done, just so you guys can think about it the way we think about it, is we counseled everybody in the pre-application process, like how much money do you qualify for? Then we actually help people with their applications. The reason was that the forgiveness needs to go back and compare itself to the application. And so you need to be consistent. And there was a lot of willy-nilly haphazard stuff going on. And the banks were actually calling us, me and my team, and saying, what's the right way to do this package? What is this that this person gave me? I don't even get it. And so we were trying to make sure that the loan packages were consistent, and also that when we do the forgiveness packaging, which is for phase 3, that it will harken back to the application and everything will be consistent and it'll make sense. Because what we're telling everyone who can listen to me is that the people looking at your loan forgiveness, once you use your PPP, you submit for forgiveness. The people looking at it are tellers who have been repurposed, because the banks don't have walk-in customers, but the banks have too much work to do because of the PPP. So they have these employees who are idle, and they need to put them to work on where they're frantic. And they are frantic about the PPP and the loan process. So they're grabbing these kids, some of them have never taken an accounting class, and telling them to look at loan packages. And so what we're doing next is we're packaging loan forgiveness in a very methodical way. And we know enough, we talk to the banks and we say, okay, what are you looking for? And we put it together in a very tidy way, like you would prepare for an audit, so that it goes through. We know that anything over $2 million is going to be audited, period, end of story. So if your loan is between 1 and 2 million, you probably have a chance of being audited that's pretty good. Less than $1 million, I don't think it's going to be as crazy, but it will depend again on your bank. And this is the really weird part. Banks have discretion on the PPP on what they'll lend to. Like one of them won't do any foreign ownership, period. End of story, won't do it. And another one will. One of them is cool with real estate affiliations, one isn't. And so I believe, and this is a Jenn McCabe belief, that next year the SBA is going to be wise about the banks that were loose and fast and the ones that weren't. And the loose and fast ones tend to be the big guys, the ones who also were not very helpful. So Bank of America, Wells Fargo, Chase, and Union come to mind instantly for me as not having been very helpful or very smart about the process. So, you know, if you had an experience with your bank where they were not that savvy, not that helpful, didn't offer that much guidance, yeah, I want you to think about it and put your loan package together in a really tidy way. And basically look better than your bank looks is the advice. Okay, the next slide. All right.
Jen, before we get to employer tax deferral, so suppose I have a food processing manufacturer who basically has shut down the operation because his revenue source is essentially dried up for now, and he's collected $1 million in PPP funds, but he's worried that he won't be able to restart if he pays out all of the funds over the next 8 weeks to his employees. He won't have the funds to restart his business. What's a manufacturer to do in that situation?
Well, I would probably work with the finance team and our finance team and put together a model and say, okay, what if we bring everybody back at least at 75% of their wages, or we bring back some of our head count so that we can get some of this loan forgiven and maybe have a skeleton crew ready to go. Does it make sense for our business because the economy is now opening up? So at the end of our loan period, which is going to be the first couple weeks of June, are we revving back up? We probably are. We probably want to bring back a couple people. That will show that you use the money for what it was intended for. You may end up being forgiven some of the money and allowed to keep the rest. Gerry and I have talked to you guys about how we think that they're going to allow us to push the June 30th date out if it turns out that you really wanted to bring people back, but you had nothing for them to do. And so you held on to the dough and you're going to use it for payroll. It's just that you can't use it immediately for payroll. So I wish I had better advice, Gerry, but right now I hate to tell people, hurry up and spend it on people and have them sit at home. But that might be what you do to strategically keep them in limbo, keep a few people sitting ready to go back to work, or maybe unfurlough them so that you can keep the money and show them that you intend to use it properly. The other thing is Main Street loans. Idle loans, that's maybe the next step for that person in that situation. Depends on how big they are.
Yeah, I think that I agree, and I think it's a tough situation if that's the only funding that entity will have access to. They do need to be judicious about how they use it. Yeah. And it may just be that they're less concerned about forgiveness and more concerned about just restarting the company and using those funds for the intended purpose, but over a longer period of time.
It'll depend on the bank. I agree. The money was not meant to be a punishing offering. The money was meant to help people hire and keep people employed. So again, it's the intent. If you are going to use the money to create or keep jobs, regardless of the time, then great, okay? So let's move on from the PPP to other programs, because if you're listening and you're like, your hopes have been dashed, the PPP has not been accessible to you, there are other things that we can talk about. The first thing is everybody that's listening should already be deferring employer payroll tax, the Social Security piece, which is 6.2%. That is a significant amount of money for most companies. You need to do it right away, though, because you can't go back and do it. You have to do it starting today with payrolls going forward. Even if you have the PPP, listen to me now, you can defer your payroll tax. The minute that you get a letter from the SBA that says a portion of your loan has been forgiven, then you stop, okay? But for right now, this puts money in your pocket. This is very important. This is a very important tool that I hope everybody's listening to me about. You don't pay it back until the end of December 2021 and 2022. And if you then get the note that says you got your PPP forgiven, and you say, okay, stop it, I don't want to defer anymore, it doesn't mean that you have to pay it back right then. Whatever you've deferred at that point gets deferred. So this is a win-win, win-win. Listen to me, do it, okay? The other thing about the deferral is that you can couple it with the retention credit. which I'm going to talk to you about next. And if you go and you hang up on me and you say, this girl Jen told me to defer my taxes today, and you call your payroll processor and they start saying things to you like, ooh, I don't know if you should, just know that they don't like doing this because it's a little extra work for them, and they also don't get your cash flow. They don't get your float. They're not going to make money by taking that tax from you, holding it for 3 days and paying it 3 days later or 5 days later. This isn't great for them. They don't want to do it. And so they're going to write you a note that says, you better sign this, that says you understand that this is your tax liability and your obligation. And by the way, it always was. This is no change. They've figured it out. They've gotten a lot better and a lot more helpful, to the point that they are now actually offering to impound those taxes for you and remind you of it at the end of the next 2 years, which is smart because that means they're keeping you as a client. And a lot of people hate their payroll processors, and so they switch around. So now that they're being cooperative, it means that they're being good business partners, which is good news, okay? So let's go to the next slide. All right, so I don't want to blow anybody's mind. This is the simplest way to think about it. So on the very left side, it says employer payroll and tax deferral. I'd like everybody to do it. If you go down to the first box here, it's okay for the PPP loan and for recipients until forgiven. All right, now say that you don't get the PPP loan. You would, I hope, be considering the employee retention credit. This credit is up to $5,000 a head, so it's a significant amount of money. And if you have less than 100 employees, so you truly are a small employer and you're subject to, say, a shutdown, so you're not at work totally, and say that you've got Jenn Ryan and Jenn McCabe and Gerry Clancy on your payroll and you're paying us, but we're not doing any work, or we're pretty useless, you should be calling us about this because you can get a $5,000 credit up to, it's half my wages up to $5,000 if you keep me on your payroll and I'm doing no work. So if you have less than 100 people, you get a credit for all 100 of your up to 100 employees, even if I'm not working, but Jenn Ryan is working her butt off. So if she's 100% productive and I'm not, you still get credit. It's meant to help, especially small employers. And it's meant primarily to help people who are benevolent employers who are keeping people on their payroll, even though they're not very productive or not productive. So it's easiest for people in manufacturing where you have a lot of hourly workers and say that you pay people and you've written notes to your staff that say, I'm going to keep you on the payroll till the end of May. I know you can't go to work, but I'm going to do it. It's meant to help you. That's a very simple example of who really should benefit from this credit. It's a little complicated in terms of what you do to document the credit. And so what we're doing is creating a process to document your eligibility first. Yes, you're eligible. And then second, which wages are eligible? Both Jens, one Jen. Can you take credit for Gerry Clancy? Maybe not, because he's checking his email once a day, who knows, but you have to document this. And then the last piece is this credit comes to roost on the 941, which is a very humble tax return. Tax people who are doing fancy tax work do not mess around with payroll tax returns. That's done by your payroll processor. So, and my team, I have a very humble HR and payroll team. We're going to be doing a lot of 941 reviews and revised 941s where you go back and get this credit, okay? So it's a little bit grungy. You got to get your knees dirty to get the credit, but it's worth it. If you have, 50 people and you get $3,000 per person, it's a credit. So say you've deferred your payroll tax. That means you pay it later. But if you also get the credit, you take the credit and apply it to your deferral and you never owe it. And that is really powerful savings for small businesses. So if you're listening and you're one of those folks who doesn't have a PPP and you have sort of some useless staff, but you're still paying them, please think about this. It could really help you. All right, next slide. This is my summary on that. It's this employer retention, we call it the ERC. Some of your payroll companies have set up codes for this, by the way. Be very careful. Don't just slam hours into that code and go, woohoo, I'm going to get the credit. You need to document your eligibility and the wage eligibility. So it's not that simple, and it bothers me that they're trying to do that. It worries me. It's supposed to help employers who are paying people, even though they can't really do their job. And I've said it's 50% of wages up to $10,000, which is, I don't know why they say it like that. It should just be up to $5,000 per person, and then you can figure out the math. All right, the next slide, please. Now, eligible employers, there are two ways to be eligible. I'm talking about shutdowns right now because every one of us is on a webinar right now because we're stuck at home and we're in a shutdown situation. We've all been subject to shutdowns now. So that works. That's one of the criteria. Are you subject to a partial or full shutdown? Do you have a government order? And almost everybody I talk to says, well, hell yeah, I do. So I got to start on this. Next quarter, at the end of second quarter, if we can show that gross receipts drop by at least 50%, that's another way to be eligible. But you have to compare quarter on quarter versus last year. Thus far, I really don't know anyone who's lost 50% of their receipts in the first quarter versus last year, although that would also be an eligible motive. And this starts, by the way, on March 12th. So any payroll after March 13th, there are credits you can go back. Unlike the deferral, you can go back on the credit to payrolls, and you can grab that credit back to the March 13th period. So it's worth doing it payroll by payroll. When you have more than 100 employees, you have to identify the folks who are not productive. So you actually have to go through the payroll, transfer their hours onto a pay code, and then have that report so that you have a documented file of the people that were not productive. If you have less than 100 people, it's a much less rigorous requirement, but I would still be documenting your eligibility for the credit in terms of government shutdowns or drop-in receipts. Okay, next slide. All right, so we've been talking a lot about the PPP, which what bothers me most about the PPP is that it's an 8-week program and everybody's so focused on it. I think they forget, yeah, I got a lot to do in the long run. So don't get to where I call it navel gazing, financial navel gazing. Don't do it. You got to pick your head up and look forward. Really think about your long-term cash and liquidity plan. So the PPP money needs to be planned for. You need to have a plan for how you're going to do it. And Jerry's question was the question of the day always is, when do I rehire? But then you have to have a much longer plan in place right now. And then you must have an HR business strategy. I'm in the outsourcing part of Armanino, so that means accounting, finance, restructuring, and human resources. In my world, HR is a part of accounting, and HR is a business strategy. I like to say that my HR team doesn't do the baking cookies on your birthday HR. It's all about the numbers. It's not about people. So I think that it's really important that you budget for what's going to happen to your HR stuff. You need to figure out, you're going to save a bunch of money on travel. So, you know, you accounting people out there, you've got to budget a lot less for travel and a lot more for tech. You need to Zoom your butts off all the time. What are you going to do with your office space? What are you going to do about your employer liability policies? Like, how liable are you if you bring someone into your office and you didn't do temperature checks and therefore you got your client sick or an employee sick? That's really the most likely scenario, is that an employer is going to say, hey, you know, Jerry came in and he sneezed all over the place and you let him work and now I'm sick and I've lost some pay. So everybody needs to be thinking about rewriting HR policies. It's going to happen in the next 2 weeks to a month. So we have a back to work checklist that we're going through, and we're rewriting travel policies. And say that Jenn Ryan has Italian family and they come to visit her. Does she have to notify you? And is she quarantined? Are you going to not let her back to work until her Italian mama goes back? You know, these are important things. Are you going to make sure you're watching for discrimination at your workplace against someone who is of Asian descent? Are you going to be accidentally discriminating in favor of Gerry Clancy because he passed the antibody test and therefore you don't have to worry about Gerry and you know he's not going to come up with a lawsuit? So these are important things that are HR that actually are accounting issues. They are financial issues. So my advice is for everybody listening, think long term. Next year, do you have enough money and do you have brand new HR policies? You cannot use your old handbook anymore. You got to think ahead. Okay, this is a liability and insurance issue, and it's a work comp issue now too, because you have less people coming to work and less people traveling, so you should revise your work comp and your general liability policies. There's a lot of operations things for everybody to be thinking about now, and I think we can, now that the economy is starting to talk about opening up, even if it shuts down again. You got to be ready. Now you got to be ready for shutdowns. All right, next. I think I'm about ready to hit it with Gerry. Okay.
Okay. Next. All right. So just to spend a few minutes on maybe a little bit of background on the new Tax Act, you might recall that a couple of years ago there was a Tax Act of the TCJA, which had a lot of positive aspects to it, but in exchange for things like a lower corporate tax rate and a lower individual tax rate, they sort of cut back a lot of the tax incentive related items like net operating losses and those types of things, interest expense. So in exchange for lower tax rates, they got rid of some incentives. So what's interesting right now is that, and those applied for years beginning in 2018. So you almost have a tax regime, just to speak in generalities, a pre-2018 tax regime. You have a 2018-2019 tax regime, and now you have the CARES Act tax regime. So there's a lot of tax law movement and changes over the last several years, which, you know, on one hand makes it challenging, but on the other hand presents all kinds of interesting opportunities. So with that, when we discuss the CARES Act, you know, one of the first things they did is they extended the time to file and pay taxes for anything that was due on 4/15 to 7/15. Actually, anything that was due after 4/1 was extended to 7/15, whether it be a tax return filed or a payment. So there's a grace period right now where no one really needs to make any payments or file anything.
So Gerry, if I think I'm going to get a refund, I still want to rush it, right?
You do, although, you know, the question is, you might want to think about the rest of what we're going to go through today, because there might be some things that will actually increase the refunds as we go through this. So it's a pretty dynamic situation in terms of each client's uniqueness in applying this. Some clients, yes, if it's really clear, you want to go ahead and get that refund in right away and get that return filed. Put that money in your pocket. Most states have also extended these extended payment dates and due dates of tax returns. And only a few have anything that's due before July, although you'd have to check individual states. Net operating losses. So that's an area where there was a set of rules back prior to 2018. Basically, it was a 2-year carryback to 20-year carry forward for corporations. Then in 2018, they limited the carry forward to an 80% rule and eliminated carry back. So the new act essentially does away with the 80% limitation for NOLs generated in 2018, 2019, 2020. And then for those years, provided for a 5-year carryback of those losses. So this is a tremendous potential cash flow positive for companies if this is applied correctly. One of the things that we're looking at.
Okay, I'm a dum-dum here. So I am the tax Luddite. Now, does this mean, Gerry, that I would go back and refile my 2018 tax return? I start over? Is that what you're saying?
Well, a carryback claim is its own thing. It's basically a special form that's prepared where its sole purpose is to carry back a net operating loss. And if it's done within a certain time frame, no, you use a special form. If it hasn't been done within a certain time frame, then yes, you actually would go back and amend those returns to take those net operating losses. So, you know, we foresee that most of the time it'll be using like a Form 1139 carryback claim for corporations, or a 1045 for individuals. So that's the methodology that we use. One of the things that we are looking at is consider making accounting method changes for tax purposes only, and this is not for financial statement purposes, that would generate larger losses in 2019, or larger deductions, if you will, in 2019 if you haven't filed that return. You know, there are some aspects to the tax law changes from TCJA that occurred in 2018 that where a taxpayer could actually do an accounting method change, take a big deduction that might then create a loss that you can then carry back 5 years. Or, if nothing else, reduce that year's taxable income. So those are the areas. Next slide, please. One of the interesting parts of what's happening right now is the ability to take what's called a disaster loss deduction. Now, what's interesting about this is not new law. This is existing law that's been in the code for years and years. I don't believe that they ever conceived that there would be a disaster like this, one that's pandemic related. This code section was designed for hurricanes, fires, those types of disasters. But here we have a pandemic disaster, and this code section does apply because this is a federally mandated disaster for the entire United States. And so taxpayers are going to need to look very closely at this code section, because there is an ability, if there is a loss that occurs as a result of this code section, a taxpayer can, instead of deducting that loss in 2020, can choose to actually take that deduction in 2019. So even though the cost or the loss occurred in the succeeding year, they can actually go back and take that deduction in the previous year. That could be a reason to sort of wait to file the 2019 return, right, until you've analyzed and determined, you know, what's going on there. Of course, if you're in a hurry, you could also file the return in 2019 and then go back and amend that for that situation.
So what if you have a loss, you know that this was a disaster for you, say you have losses through the end of May, your return is due July 15th, and you think you're going to have more bad news in the next quarter, do you file a further extension and wait to file, or do you file and then amend and get more?
I think it's your choice. You could do either way. And so okay. There could be multiple amended returns as this thing goes along. But it's a pretty interesting provision, because it's not related to the CARES Act, which was targeted for this whole situation, but it's there and it's available. And we are using this, like, you know, I mean, think of food that's gone bad, or certain inventory that's no longer saleable. Think of a business deal. You were planning on buying a building and you just killed the deal. Those costs relating to that business deal that didn't go through are deductible. So it's a powerful provision. It's also complex, but it's something that we're working on very closely with clients. Next slide, please. Here's another big one. Qualified improvement property. A lot of manufacturers have improvements that they've made, millions in some cases, to their facilities, and you know, especially if they did this in 2018 or 19, it used to be that this qualified improvements could be deducted vis-a-vis bonus depreciation in 1 year. Well, the TCJA Act that occurred a couple of years ago, inadvertently, by mistake, did not allow for qualified improvement property to be deducted under bonus depreciation rules. it also provided for a 39-year life rather than the 15-year life that it was intended to have. It was essentially a mistake on the part of Congress when they actually wrote the law and enacted it. So what the CARES Act does is basically say, you know what, we screwed up. We're going to go ahead and allow you to go back to 2018-19 and fix it. And you can then take that bonus depreciation. So you can consider amending 2018 or do a catch-up adjustment in 2019 related to 2018 on a Form 3115 method change. This only applies to commercial properties and only applies to interior improvements. Basically, it's sort of non-structural type things. It can't be used for things like elevators, escalators, that sort of a thing, or an outside wall, structural wall. We think that for manufacturers, this is going to be a big one. I mean, I was working on one yesterday, to be honest, and it involved a $10 million additional deduction for a client that had done a massive build out. And so you then create this loss in 2018 that you now can carry back to 5 years and get back those funds relating to the loss at remember, higher tax rates. The corporate rate now is 21%, but back then it was 35%. So there's a rate arbitrage that's also going on here that is something to really consider. Charitable contributions for those companies that are doing great, and there certainly are plenty of manufacturers that are actually doing really well right now. The limitation for deductibility for qualified contributions has been increased to 25% of taxable income. I think what this is for is think about all the charities that are really going to suffer because of the economic decline, and they're not going to be getting the contributions that they were planning on, and they're in a state of chaos and financial distress themselves. So this gives the ability to make larger contributions for corporate type entities. Another refund opportunity, minimum tax credit. So not to get too far into the weeds on this, but basically C corporations have minimum tax credits that relate to differences between regular tax and alternative minimum tax. And when alternative minimum tax applies, like with respect to a net operating loss claim, for example, you're not able to actually, you'll pay an AMT tax, which then becomes creditable in some future year. Well, the question is, when will that become creditable? So what's essentially happened is that Congress has decided that, you know what, if a company has a credit on their, as an attribute in their tax return, we're going to just go and let you get that refunded back to you. And so there's a process for doing that. So we're looking at each and every client, looking at their what are called tax attributes, determining whether they have any of these AMT credits or any credits like that, minimum tax credits, and we're getting those refunded. Next slide, please. Interest limitation, I mentioned this briefly. Again, TCJA a couple of years ago came up with this 30% rule where leveraged businesses could only deduct interest up to 30% of adjusted taxable income. And again, this really impacted leveraged businesses, and there was all kinds of limitations that were being applied. Congress expanded that to 50% of adjusted taxable income, thus allowing for more interest to be deducted in 2019 and 2020. And then, of course, there's a lot going on with respect to people working from home, home offices, setting up Zoom, setting up their computers, buying them computers, which constitute fringe benefits. And what the Congress basically decided is we're going to go ahead and make all those things non-taxable to the employees. So there's a benefit there that they're allowing, rather than putting that in their W-2, they're just allowing that to be a tax-free fringe. Next slide.
So this is, Gerry, this is an area where HR policies overlap with accounting and tax again. So how long is that new rule? Is it only for 2020 that you can reimburse employees and not roll it into their W-2 for those things, or is this a new normal?
At the moment, it's a permanent provision. I'm not aware. I don't really know the answer to that question, but I'm not aware of it being a temporary provision. Did you have any thoughts on that?
I don't think it's temporary. I actually think because HR policy and payroll policy has to change to conform with new HR, that it's probably the new normal, because work from home is going to be something we have to do. And I think work from home now becomes a business expense, not a person's expense that then they get reimbursed at a taxable. It's like you increase their wages in the old days. This is now a business expense of the employer. It's a valid and necessary and usual one. It's just dipped into necessary and usual for the first time.
Yeah, the fact that the employee benefits by having these things is a mere byproduct of the convenience of the employer. So,
yeah.
You know, I did not see any sunset provisions on that. Like you've noted here, where we've discussed different years in which these tax laws apply and then they don't apply for future years. I didn't see any of that with respect to this provision, so I think it is permanent.
Good news.
Okay, state and local. Now, look, there's also an ability through apportionment analysis. Apportionment is a process of determining, you know, how much income and tax is paid into various states. So we do a lot of work with respect to apportionment analysis and trying to get losses into states that have the ability to carry back NOLs to prior years. And then, of course, in state by state and locality by locality, you need to look to see if there's deferral mechanisms for things like license fees, gross receipts tax, payroll taxes at the state level, you know, business license fees. Every state and every locality has their own set of rules that you can look at to see if you can push those expenses out a ways. Now, when it comes to transfer pricing, you know, this is basically a methodology where if you're doing international operations and you've set up what's called a transfer pricing arrangement with another entity in another country, you have an opportunity right now to change that arrangement. And what I mean by that is, let's say that you've got an arrangement that, you know, right now you're losing money like crazy in the United States, but your foreign entity that you've got a transfer pricing arrangement with that you own is making money because of the transfer pricing arrangement. You can now go back and revise those so that you balance out the taxable income in the foreign country with the taxable income in the United States. So we're helping clients with those arrangements and modifying them. Next slide, please. Section 382, and apologize if I'm throwing code sections at you, but it's kind of how we think in the tax world. That has to do with changes in ownership and the ability to use net operating losses and other tax attributes, but primarily net operating losses when you have a change. So here's the thing. Right now, companies are raising cash because of their financial distress. But when you raise cash, you might have different ownership changes because of what the company's value is and who's coming into the picture. When you have a change in ownership, then you actually then have to look at whether or not it constituted a change that would then cause this 382 provision to apply, where there's a 50% change in the ownership. Then it's a very sort of punitive ability or very difficult ability to use a net operating loss when you have a change. So it's a tricky area. It could really impact the ability of companies to use NOLs, and it might affect whether a company would decide to actually go raise equity funding versus debt funding or something else. And then lastly, 409A, which is an area that deals with deferred compensation and employee compensation. And it's a very sort of restrictive code section. But right now, we actually have an opportunity with lower valuations of companies where maybe you'd want to go have a what's called a 409A valuation to revalue those stock options, because it might be that it creates an opportunity to exercise those options in a way that produces a lot less taxable income to that employee. So we view this as an opportunity right now in the downturn to get those valuations done, to basically inform the employees that, hey, this might be a good time for you to exercise that option at a time when there would be little to no taxable income reported to you. Next slide. And that's it. So we did it in 57 minutes. Hopefully we didn't bore you to death.
No, Gerry and Jenn, thank you so much. I'm going to sneak in from the pre-registered questions. Do you guys mind if I try to sneak a few in?
Nope.
Okay. One of them that I'm picking out is it says, oh, here we go. What if you are ghosted by the lending institution you applied with? It's been 4 weeks without a response. Are lending institutions required to respond within a specific time?
They are not required to respond ever. They have ignored lots and lots of people. If you've been ghosted, it probably means you're not going to get a PPP loan. And right away, start looking at the other means, deferral credits, other loans, idle loans, things like that.
Perfect. Another one we had was, should we create a unique payroll account with 100% of the PPP fund to create cleaner accounting?
I would absolutely set up a separate account. Is for sure it is best practice. I would not link my payroll to it because remember, this is just short term. Instead, treat it like a reimbursement account or an impound account. And when you pay allowable expenses, transfer exact to the penny amounts out of your PPP account and then document that transfer and be sure you know what you're doing. Remember, it doesn't cover all your payroll. So you need to split things like your medical insurance bill into 2 pieces, your payroll into 2 pieces, and document yourself. But that is a great start.
Excellent. Another one is, can a new 2-person home-based business take advantage of the CARES stimulus bill or any other programs?
Yes, if you were a new business before February 15th, yes. If you started it in 2020, a lot of provisions are limited, but it says, if you existed before February 15th, there's hope for you.
Excellent. I'm looking here. Partner recently moved the business in the past month, and they'll be reinvesting in electrical wiring and power to run the machines. Is any part of the PPP could be used for this?
No, that's a definite no.
Okay. This is perfect. You guys are so fast. You're so knowledgeable. I'm getting through these questions. We are owned by investors that are out of the country and don't have a social security number. Can I apply for the PPP loan without a social security number?
No, and it's only for United States majority owned companies. You have to show that you have at least 51% owned by US citizens, and some SBA lenders will not loan to anybody with foreign ownership, period.
And then are there any, this is one person's question, 2 parts. Are there any programs for capital expenditures? And one of my employees makes over 100K, do we have to pay back the difference?
You are only allowed to get reimbursed for the 100,000 up to that wage. Anything over that is not allowable or forgivable. And the loans are not to be used for investment in new stuff. Remember, the PPP loan is only for payroll, utilities, and rent, so it wouldn't be used. The idle can be used to fix your equipment, but not really necessarily buy new stuff. So remember, these are disaster recovery. Okay. I think the Main Street loan, though, you could use for that. All right.
Excellent. We like to end on time, so I'm going to say that I'm so impressed you guys were able to let me blitz those questions. What I'm going to say is that, as we mentioned earlier, the session has been recorded and the link will be sent out. In closing, I want to thank Jenn and Gerry for just sharing with us their incredibly deep and broad knowledge, and really thank our partners. You're investing in creating a community with Xometry, and we're highly appreciative. Thanks, everyone.
Thank you. Thanks very much.